Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999.
Ensuring you are making the most from your investment property. Today I'm talking to Mark Chapman from H&R Block to discuss the rules, advantages and disadvantages of renting your property. Thank you so much for joining me today, Mark.
It's a great pleasure.
Mark, can you please explain to us what the rules are about renting out your own house and the 6-year rule and how to avoid paying any CGT on your own home?
Yeah, well, basically, your family home is CGT free. But if you move out of the family home, if you leave it vacant, you can actually extend that main residence exemption for up to 6 years while you're absent. That's assuming that you use the property to be rented out. If you leave the property completely vacant, then you can actually extend the main residence exemption indefinitely. So it's a very significant exception, which can save a great deal of tax in the right circumstances.
Can you break up that 6 years and rent it for 3 years, leave it vacant for 3 years, then rent it for another 3 years? Or does it have to be consecutive 6 years?
Yeah, it does have to be consecutive. So if you, for example, you rent it and then move back in, you trigger a second 6-year period. But essentially, you can get 6 years completely tax-free, provided you're renting it out.
If I rent it for 6 years, I come back and live in it for a year or so, and then I rent it for another 6 years, is it all going to be CGT free?
Yeah, absolutely. It'd be CGT free in that situation.
Wow. So you could do it really indefinitely then?
Yeah, absolutely.
To move back in and out. What are the reasons that you're able to rent out this property without it becoming seen as an investment property?
Well, it actually is an investment property for the period that it's vacant, so you can claim all of the deductions that you can on any other investment property. Having said that, the reason for the 6-year absence rule is basically to give people flexibility to move out, to potentially get a job overseas or interstate, and not actually lose the main residence exemption as a result of that.
And Mark, at this time when we've been, going through the pandemic and people might have been stuck overseas or interstate and not able to get back to their homes, is it extended at all? Is there any flexibility for people tax-wise that, they might have had to rent out the house for a bit longer than they expected?
No, unfortunately, there's no flexibility. COVID-19 obviously has changed a lot of people's plans, but nevertheless, if your absence extends beyond the 6-year period, for example, because you can't get back to Australia because of COVID, you still only get the exemption for 6 years. Therefore, basically, you get a partial main residence exemption for the period that you actually lived in the home, plus the 6 years. But once we go beyond that, the main residence exemption doesn't apply.
And so can that be quite expensive or quite an expensive liability?
Or potentially, I mean, you've got to look at the cost base of the property, the proceeds of the property. The difference is the total gain, and basically you subdivide that between periods that are going to be exempt and periods that are not going to be exempt. So, potentially, if there's a substantial gain, then potentially any period where the main residence exemption doesn't apply will actually be quite significant.
And at this time, I guess it is quite significant because properties really have...
Absolutely.
Yeah.
Yep.
So if someone is, renting out their property and renting another that they want to live in, does that actually make good economic sense?
Oh, look, it can do. I mean, basically, you've got to compare the costs of renting somewhere else versus the income that you get on on your own property. But you've also got to factor in all of the deductions that you can potentially claim on the property as well, and that can potentially make it quite an economically viable alternative. But just from a lifestyle point of view, lots of people want to get on the property ladder. So, first-time buyers, they buy a house, they live in it for a while, but it's not really intended to be there forever homes, so they basically move out and then rent that property, and themselves they rent somewhere else. So there's a mixture of economic benefits and also lifestyle benefits in doing this.
Yeah, I've heard of quite a few people at this time who have been stuck at home and their actual home is too small, or it's in an area they don't really want to live in when they're being stuck there. So they've rented another property, which has generally been a larger rent than they're earning. And I guess unless you're getting deductions and so on, that it is an expensive exercise.
Yeah, I mean, you've got to look at this over the longer term. So, but you're getting lots of deductions on an annual basis, deductions for depreciation, repairs, interest, etc. But also, you're potentially you've got to factor in the capital gains as well. So potentially, if you're getting the main residence exemption for 6 years, you may not actually have any capital gains. So looking at it in total, it can work out to be quite lucrative, even if from a cash flow perspective, it is quite expensive on an individual yearly basis.
And so you just said that if you're renting out the home for a period, you can claim the interest to negative gear the property. Is that correct?
Yes.
Yeah. So that is a big deal, I guess.
Yeah, absolutely.
So if you do go beyond that 6 years, how is the tax calculated?
Well, basically, it's calculated using a time apportionment. So the periods of main residence, the periods of non-main residence are combined, and the period that the property is not actually your main residence is going to be subject to capital gains tax. Obviously, that doesn't include the 6-year period, so potentially that can reduce it quite considerably. But it is worthwhile noting that it could be a significant tax liability.
Is the date relevant then, or is it just proportionate? Like if the house has gone up in that 2 years more that you've rented it out and it's no longer your main residence, if it goes up in that period more than it's gone up in the other 10 years that you've owned the house, are you paying for that, or is it across the whole time frame?
No, you simply look at it over the whole time period, but you basically smooth out the property increases over that time period.
Okay, I guess that makes it a little bit more attractive if you need to sell it right now and you've suddenly got that big gain. Do people generally try and work it out before they do decide whether or not they're going to move back and so on? Is that something that you perhaps as an accountant help people with?
Yeah, look, to be honest, most people tend not to be so organised. Most people tend to come along to us some way down the track when the property is being sold to work out what the actual capital gains tax liability will be, and then we work it out from that perspective. Having said that, ideally, you want to get a client in front of you before they actually rent the property out, so you can talk to them about the options that are available. Given that most people aren't that organised. Generally, you're dealing with a client who's done something and simply wants advice about what the tax implications are after the event.
And I guess there's times where someone might be paying a lot where they could have just left the place unrented for a year or so, and I guess not had that burden on them.
Oh, well, I mean, there's always advantages in having the property rented in the sense that you're getting income and you're claiming deductions, but that's balanced against the 6-year absence rule. Obviously, if your property is left completely vacant, it's actually then an indefinite absence rule. So that there is a balance to be taken into account there.
And do you have lots of clients who have gone through this recently?
Oh yeah, I mean, this is fairly consistently one of the major exemptions that people take advantage of. They rent their property, they aim to have the rental end within 6 years, and then claim the main residence exemption for the entire period. It's fairly consistently popular move. Yeah.
And what sort of people do it? You said first home buyers. Is that the most common strategy?
You get a lot of people who have to move for work, people who are moving interstate or overseas. So they tend to be a popular user of this strategy. But then also first home buyers as well, because as I mentioned, they very often don't have that emotional attachment to their first home. So they're quite happy to live in it for a bit, but then move out and rent somewhere. So they're also a big user of this rule.
And are the tax rules different if you're moving overseas? Is it still classified as your main residency if you're no longer domiciled in Australia, for example?
No, unfortunately, if you go overseas and you become non-resident in Australia for tax purposes, then the main residence exemption simply doesn't apply at all if you sell a property whilst you're overseas and non-resident. So basically, in that situation, you can forget the 6-year rule, and you can also forget the main residence exemption. So don't sell your property whilst you're non-resident. Basically, if you go overseas, you become non-resident, move back to Australia, become resident again, and then you can take advantage of the 6-year rule, the main residence exemption, etc. But selling the property whilst you're overseas is obviously a no-no.
That's very helpful advice. Now, are there different tax rules if your primary property is in another country and you're living back in Australia? So if you've been living in the UK, for example, you bought a property there and you move back home, how is that calculated?
Oh, in that situation, it's exactly the same as an Australian property. So basically, your main residence exemption is your main residence exemption, is your main residence wherever you live in the world. If you live in the UK or the US, whatever, that property is your main residence and you're entitled to the exemption for that.
Great. Thank you. Thank you so much. I think that's been very helpful to everybody today.
Thank you. Great pleasure.
You've been listening to Mark Chapman from H&R Block today here on Friends with Money. Please remember to subscribe to our podcast wherever you listen to your favourite podcasts.
Thanks for listening to the Friends with Money podcast. For credible, independent and easy to understand financial commentary, visit moneymag.com.au. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.